What if the biggest threat to your financial future isn't inflation, a market crash, or even a recession, but a quiet shift in the global financial system that most Americans never even noticed? Because in June 2024, something happened in the global oil market that analysts and energy traders immediately started paying attention to. A long-standing framework that had helped anchor the relationship between the United States, Saudi Arabia, and the global oil trade quietly reached the end of its 50-year window, a system that many people refer to as the petrodollar system. For decades, this arrangement encouraged oil, the most important commodity in the modern economy, to be traded primarily in U.S. dollars. And that mattered more than most people realize, because when the world's most important resource is priced in dollars, countries everywhere need dollars to buy it. They hold dollars in reserves, they settle trade in dollars, and their financial systems become connected to the dollar, whether they want them to or not. That dynamic helped cement the U.S. dollar as the center of the global financial system for nearly half a century. But over the last few years, the energy market has been evolving. Saudi Arabia and other producers have increasingly explored accepting multiple currencies for some oil transactions as trade relationships shift toward Asia and emerging economies. And when reports surfaced that the original framework from the 1970s had effectively reached its expiration window in 2024, it sparked a much bigger conversation among economists and geopolitical analysts. Are we witnessing the beginning of a multi-currency energy market rather than one dominated primarily by the dollar? Because the petrodollar system wasn't just about oil, it was part of a much larger financial architecture, a system that helped shape how global trade worked, how the United States financed its debt, and why the dollar became the most widely held reserve currency on Earth. So the real question isn't simply whether one agreement expired in June 2024. The real question is whether the global monetary system may be entering a slow transition that could gradually reshape the balance of economic power. And if that happens, what it could mean for the purchasing power, savings, and financial future of millions of Americans in the years ahead. And to understand why this moment is generating so much attention, we first need to step back and understand something much deeper: how the petrodollar system actually worked in the first place. Why did oil become so important to the global financial system in the first place? Because energy is the one resource every modern economy depends on. Every country needs oil to power transportation, industry, agriculture, and trade. And when the world's most important commodity is priced in a specific currency, that currency suddenly becomes far more powerful than it would be otherwise. After World War II, the U.S. dollar had already become the central pillar of the international monetary system through the Bretton Woods Agreement, where currencies were linked to the dollar, and the dollar itself was tied to gold. But that system changed dramatically in 1971 when the United States ended the gold convertibility of the dollar. Suddenly, the dollar was no longer backed by gold, it was backed by trust. And that created a serious question for the global financial system at the time. Why would the world continue holding large amounts of dollars if those dollars were no longer linked to a physical asset? The answer emerged just a few years later through a strategic relationship between the United States and Saudi Arabia. In the mid-1970s, a framework developed where Saudi Arabia, the world's largest oil exporter and the leading voice inside OPEC, agreed to price and sell its oil primarily in U.S. dollars. Because Saudi Arabia played such a central role in the global oil market, other major oil exporters followed the same practice. And that single dynamic changed the financial architecture of the modern world. Because if every country needs oil, and oil is priced in dollars, then every country needs dollars. Japan needed dollars, Germany needed dollars, China needed dollars, India needed dollars, not necessarily to trade with the United States, but simply to buy energy. This created what economists often describe as structural demand for the dollar. Countries held large reserves of U.S. currency, not just because of American economic strength, but because the global energy system required it. And that constant global demand for dollars helped reinforce the dollar's position at the center of the world economy for decades. But that's where the story becomes even more interesting, because the real power of the petrodollar system wasn't simply that oil was priced in dollars. The real power was the chain reaction it created inside the global financial system. But this is exactly where the story begins to shift from history into the present. Because over the last decade, the global energy market has started to change in ways that would have been almost unthinkable 20 or 30 years ago. New economic powers have emerged, trade relationships have shifted, and the center of energy demand has gradually moved away from the West and toward Asia. Today, countries like China and India are among the largest buyers of oil in the world. And that shift has begun to influence how major energy exporters think about currency and trade. Saudi Arabia, for example, now sells a significant portion of its oil to Asian markets, particularly China. And when your largest customer prefers to transact in a different currency, the pressure to adapt begins to grow. Over the past several years, discussions about settling oil transactions in multiple currencies, including the Chinese yuan and other regional currencies, have increasingly moved from speculation into reality. Some energy contracts between China and major producers have already explored non-dollar settlement mechanisms, while financial infrastructure outside the traditional dollar system has slowly expanded. None of this means the dollar is suddenly disappearing from global oil markets. In fact, the majority of oil transactions are still conducted in dollars today. But the key change analysts are watching is not a sudden replacement, it's diversification. Because once energy exporters begin accepting multiple currencies, even on a limited basis, the structure of the system begins to evolve. Instead of one dominant currency anchoring global energy trade, you gradually move toward a multi-currency environment where different regions settle transactions in different currencies. And that shift may seem subtle at first, but over time it can have profound consequences for how global demand for dollars behaves. Because the petrodollar system depended on one simple principle: if you needed energy, you needed dollars. But if energy can increasingly be purchased in several currencies, that automatic demand for dollars becomes less absolute. And that is why economists, central bankers, and geopolitical analysts have been watching these developments so closely. Not because they signal an immediate collapse of the dollar system, but because they could represent the early stages of a much broader transition in how global trade and finance operate. But this is where the economic implications start becoming much more serious, because the global monetary system runs on demand for currencies, and the US dollar's strength for the past several decades has been supported by multiple layers of that demand. One of those layers was the petrodollar dynamic tied to energy markets, but it wasn't the only one. Global trade networks, financial markets, international debt markets, and central bank reserves have all reinforced the dollar's position at the center of the system. And yet, over the past several years, analysts have begun noticing small but meaningful shifts in how countries manage their reserves and settle international trade. Central banks in many parts of the world have been gradually increasing their gold reserves, often at the fastest pace seen in decades. Some governments have also explored new bilateral trade arrangements that allow them to settle transactions directly in their own currencies, rather than converting everything into dollars first. Payment networks outside the traditional dollar-based infrastructure have been expanding as well, allowing countries to experiment with alternative settlement systems for cross-border transactions. None of these developments individually overturn the dollar's dominance. The U.S. still has the largest and most liquid financial markets in the world, and the dollar remains the primary reserve currency held by central banks. But the broader pattern matters. Because when multiple countries begin diversifying their reserves, exploring alternative payment systems, and experimenting with non-dollar trade settlements, it suggests a gradual shift in the architecture of the global financial system. And shifts like that tend to unfold slowly at first. For years, they may look like isolated changes happening in different corners of the global economy. But once enough pieces move in the same direction, the overall system begins to evolve. And that evolution can influence everything from exchange rates and global capital flows to the long-term purchasing power of the currencies people rely on every day. But this is where the story starts to move from global finance into something far more personal. Because when the structure of the international monetary system begins to evolve, the effects eventually show up in places most people don't expect. The price of everyday goods, the cost of borrowing money, and the long-term value of savings. The United States imports a massive amount of goods every year, from electronics and vehicles to clothing, energy products, and industrial materials used to manufacture other products domestically. When the dollar is strong, those imports become relatively cheaper for American consumers. But if global demand for dollars gradually weakens over time, the currency can lose some of that strength in foreign exchange markets. And when that happens, imported goods begin to cost more in dollar terms. That process doesn't happen overnight, and it rarely happens all at once. But even moderate shifts in exchange rates can quietly influence inflation and the cost of living over long periods. The same dynamic can affect interest rates as well. For decades, strong global demand for dollar-denominated assets, especially U.S. Treasury bonds, has helped the United States finance government debt at relatively favorable borrowing costs. If global investors and central banks gradually diversify their reserves into other assets, demand for U.S. debt can change, and that may influence the interest rates required to attract buyers. Higher borrowing costs ripple through the entire economy, affecting mortgages, credit markets, and business investment. This is why economists often pay such close attention to structural shifts in the global financial system. Because the consequences rarely stay confined to foreign exchange markets or international trade statistics. Over time, they filter into the financial realities of households, influencing purchasing power, investment returns, and the broader economic environment people rely on to plan their financial futures. And this is why moments like the one we've been discussing attract so much attention from economists, investors, and policymakers around the world. Because the question is not whether the dollar suddenly disappears from the global system. That scenario is extremely unlikely in the near term. The real question is whether the world is gradually moving toward a more multipolar financial structure, where several major currencies share influence instead of one dominating global trade the way the dollar has for decades. Transitions like that tend to unfold slowly. Sometimes they take many years, even decades, before their full effects become visible. But along the way, they can reshape how countries manage their reserves, how international trade is settled, and how investors think about protecting wealth during periods of monetary change. That's one reason why assets like gold and silver often receive renewed attention during times of geopolitical or financial uncertainty. For centuries, precious metals have served as neutral stores of value that exist outside the control of any single government or currency system. Even today, central banks around the world continue accumulating gold as part of their long-term reserve strategies, a signal that diversification still matters in an uncertain global environment. None of this means the dollar is about to vanish or that the global financial system is on the verge of collapse. The United States still has enormous economic advantages, including deep financial markets, strong institutions, and a global network of trade relationships. But history shows that reserve currency systems can evolve as the balance of global economic power shifts.
And that's why analysts are paying such close attention to developments in energy markets, international trade settlements, and the strategic decisions of major economies. Because if the world is entering a period where the financial system gradually becomes more diversified, understanding those changes early may help people make better decisions about how they save, invest, and prepare for the economic landscape of the future.